if the Fed is sort of realizing now it might have to go faster, or at least remaining committed to its current path, despite the nervousness in the markets, is it that, I mean, investors, have they just not got to grips with the fact that the Fed can't create semiconductor chips overnight, can't magic up more container ships overnight?
Yeah, exactly. I mean, I think in part that's, when we look at this, we've lived through a world where the problems the Fed faced were problems the Fed could resolve, and have gotten really used to that in markets in the sense that 2008, the problem was there was not enough credit. The Fed can turn on the spigots of credit very easily and offset that, right? It was bold on their part relative to what they had done historically, but they're capable of offsetting credit with printing money. They were also capable of offsetting income by printing money in this thing. But what they're not capable of is creating the supply that would have been created that would normally have generated that income. And so you're seeing that, right? And what you're seeing is we're hitting policymaker constraints. We have a measure of policymaker constraints, and certainly you want to be more bullish on markets when policymakers are free to react to any downturn in the economy. When they're constrained, and basically there's three constraints that we see that can affect policymakers' ability to step in a problem. One is when that problem is inflationary, when it's essentially a supply side problem that demands above supply. They can't just easily step in and solve that problem. The currency problems as well, and bubbles in asset prices. And today the Fed faces certainly the problem of inflation being well above their target and the inability to be as easy as they'd like to be and being pulled along by that. And certainly the increasing odds that we're facing bubbles in certain areas. And so the third problem that would really force them to move is more of a currency problem. We haven't seen that yet. But those constraints put the Fed in a much different situation in terms of the nature of the problems we face than they were in 2008 or in the beginning of the COVID crisis.
I noticed there was an interesting column that Mohammed Al-Arian wrote the other day for Bloomberg Opinion, which was making some of this point and just arguing that maybe we've got so used to focusing on lack of demand as being the key problem in the economy, we're not perhaps responding quickly enough to the fact that the world has changed and now it's a matter of supply. But look, I'm pulling out, as an investor, I'm pulling out from what you're saying two things that are somewhat disturbing. The Fed's going to carry on regardless. In response to these conditions, and potentially inflation is going to carry on regardless, maybe higher than what is currently being priced in by markets. I mean, is that something that is going to cause a problem for investors down the road, the combination of those two things, tapering and continued high inflation potentially?
Well, to be clear, I think it's really the second that will drive the first, in the sense that the Fed won't taper if they don't need to, meaning that the only reason they're going to taper is because the inflation pressures don't go away. So if you do get some sort of downturn, or that we're wrong and somehow the supply comes online to match the current levels of demand, then the Fed will probably slow down. So there is a deflationary environment where the Fed slows down. The problem is more likely in our view.
But you're not seeing that.
Yeah, you're more likely. Exactly. More likely you have the inflation dragging the Fed along. And yeah, that's risky for investors. And so what can be done here? The big thing is that the only reason the Fed's going to tighten is if they have to. They're only going to have to if nominal GDP continues to increase at a rate that's driving inflation higher. And so you can hedge your portfolio much more than most portfolios are by trying to lock in cash flows in the real economy and go short things like treasuries, but basically arb the difference between the likely nominal GDP outcomes and the interest rate the Fed's currently giving you. We don't think they'll be able to give it to you for long. So those assets are in danger when you go through the tapering and interest rates rise. But today you could still get a good deal in hedging cash flows that are likely going to be higher than the interest rate. And so that's, one of the things that we don't think enough portfolios have hedges to the main risk. The risk, in our view, to asset prices is not deflation. It's not the old risk, because we know what the Fed and policymakers will do in the end. If there's deflation, they'll print money and spend money, and that'll affect the prices of things. The problem is stagflation. That's the real risk. And so many portfolios are massively exposed. And there are ways to hedge that risk, to try to arbitrage that difference between the likely nominal outcomes and those available in financial assets today.